Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
One simple mistake could take half of your retirement account. Do you know what it is? Stick around over the next half an hour. We will tell you exactly the mistakes that people are making every single day that is taking more than half of their retirement account. Welcome to the show, Your Money, Your Wealth. My name's Joe Anderson, certified financial planner, president of Pure Financial Advisors, and I'm with the big man, as always, Big Al Clopine. We'll bring him in momentarily. But let's look at the stats real quickly, because this landscape of retirement has changed. There's over $22 trillion, $22 trillion in retirement accounts. Most of those plans were established under ERISA in 1974. And you take a look at about 8 million or 8 trillion of those assets are sitting in individual retirement accounts, your accounts. And now when it's time to take distributions, that's when you're going to pay. That's when you're going to pay those taxes. And most of you have no clue of how much tax that you're going to pay. So when you look at your retirement, you have to consider the taxes, because those things are infested with tax. We're going to talk about how to avoid those taxes as much as you can. And that's what's on my mind today. So if you look, 22 trillion, 24 trillion, something like that, are sitting in retirement accounts, and the IRS right now is salivating. They are so excited. They're waiting for three things to happen. They're waiting for you to make a mistake. There's a lot of mistakes that you make in regards to your overall retirement accounts, in regards to the amount of tax that you don't know that you're going to pay. Secondly, they're waiting for you to reach a certain age. That is age 70 and a half. That's a mandate by law that you have to start pulling money out of those accounts. And they're also waiting for you to die. They love it when you die with a lot of money in those accounts, because it's a huge tax. And guess what? You're not complaining. So to dive in deeper, let's bring in the birthday boy, Mr. Alan Clopine.
We're doing a show on IRAs.
Hawaii.
Yeah, it's all about
studio.
Hawaii at my birthday. That is totally cool. Totally cool.
And of course, we have a treasure trove of
boogie
wonderful
board?
things for
Like
you.
it? I know how to use that.
For Hawaii.
Towel, need that?
And we want to make sure that you're properly spritzed.
Oh yes, thank you.
Oh.
Jeez. Back at you.
And of course,
Oh, perfect.
you know, without
Perfect.
swim trunks,
Yes.
it's just not Hawaii vacation. So we can't wait to see you in those.
I need some new ones. Perfect. Okay, those will
And the
work really
team
nicely.
wants to make sure that you feel.
Those will fit?
I'm going to stuff myself into it one way or another.
And
Sunscreen,
some much
yes.
needed sunscreen.
Wow, this is
So,
unbelievable.
No excuse not to have an amazing birthday.
Well, thank you, hon.
Oh,
All right.
Happy birthday.
Thank you.
This is Erin Kuba. She made this amazing cake for you from Kuba Creations. Can you tell us a little bit about the cake?
Yeah, well, we heard about your love for Hawaii, so we thought it'd be fun to do this erupting volcano, and everything on there is made from sugar, and you can even eat the trees.
Now,
so.
is there actual molten lava inside it?
Just pretend, but
Pretend, okay.
yeah, but you can eat everything inside, and it's our signature lemon lavender flavor.
Wow. Now, that's going to be quite a slice when I get this.
Watch out, it could really get crazy.
Apparently.
And
Well,
the board is in the shape of the Big Island, too.
You know what? It sure
Yeah.
is.
Very,
It sure
very
is. Very cool.
Well, happy birthday, Big Al.
Well,
We're gonna have
thank
to
you
get
so
back
much,
behind
man.
the scenes there. We're hijacking
Oh,
the show.
don't forget your bag.
Oh,
while you're
okay.
getting-
Okay,
But
perfect.
enjoy the Hawaii,
Perfect.
Your Money, Your Wealth.
Well, thank you very much, you guys. That was very sweet.
Well, happy birthday, my friend.
Now, yeah, that's cool.
Yeah, I think
Like
we're
it.
just going to have this the whole time.
Might as well.
You know, I think there could be a video. I think there could be a little bit of a package. So let's see
Yeah,
if
let's
we
see.
can roll
See what
that.
we got.
Wasted away again in Margaritaville.
Okay, let me get in the zone. This is the key. Start today. Sunday mornings at 6:30 a.m. on CBS Channel 8. Excuse my
Searching for that lost shaker and salt.
Sorry. There you go.
And you know what? It's so good. I think you kind of stole my thunder. You want to start early. You want to save often. You want to save as much as you can. And we're going to get into that into the show and into some strategies to be able to do that, thereby allowing you to keep more of your profits. Watch Your Money, Your Wealth on Saturday. Oh.
Wasted away again.
That's my blooper roll. That's the only mistakes I've made all season.
Yeah, whatever. Whatever. Al, let's dive into the show. We got a lot of IRA talk to talk about. So what are some of the IRA mistakes that people are making?
Well,
If you even know.
yeah, I do. All right, so there's basically four categories of mistakes, Joe. And I guess the first one is people are forgetting that these accounts are taxed. You pull money out and you got to pay income taxes. 59.5 is when you're allowed to take money out. You avoid the penalty, but you still have to pay income taxes. So factor that into your retirement planning. And then required minimum distributions, you have to take those at 70.5. So that means if you have an IRA, you have to start pulling money out of it, whether you want to or not, at 70.5. A lot of people forget that. And there are some pretty big penalties when you don't do that. Now, beneficiary statements, we see a lot of mistakes there. We're going to dive into that a bit. And then here's one that you may not know much about. That's inherited IRAs. Boy, there are some do's and don'ts, and we have seen accounts evaporate 50% or more from some of the mistakes, Joe, and that's why it's good we're getting this information out there.
Simple mistakes like this is that you take a look at your account balance and then you figure, all right, well here, let's say I have $200, $500, $1 million in those accounts, and that you can spend it all. And that's just not the case. Let me tell you a quick story. There's an individual that just retired. He has a huge pension and Social Security, about $150,000 of fixed income. So giant pension, nice Social Security. He goes, Joe, you know what, I think I'm doing pretty good in my retirement. Then he goes, I think I made a mistake here. I go, all right, tell me a little bit more. He goes, well, when I retired, I wanted to be debt-free, so I paid off my mortgage of $350,000. I said, okay, so far so good. You spending you have $150,000 of income. You're debt-free. What could be wrong here? He goes, well, I had $1 million in my retirement account as well, and we spent about $50,000 a year. I said, everything sounds perfect. What is the mistake? He goes, well, I pulled the money out of my retirement account to pay off the mortgage. And I go, did you have any other assets to pay off the mortgage? He goes, no, I had this giant amount in my retirement account. I just cut a check. So do the math here, Al. You're the CPA. If I have $150,000 of income, then you add $350,000 of a taxable IRA distribution, your income is $500,000. Next year, when he does his taxes, guess what? How much is he going to owe?
Yeah, it's probably about half of his IRA balance.
Right.
I mean, of what he withdrew.
Right, so $500,000 of income, he's probably going to owe another, what, $200,000 of taxes. Where does he have to go to pay the tax? Well, he's got to go back to the retirement account to pay the additional tax for him to pull the money out to pay off the mortgage. So now the following year, his income is $350,000, so he's going to owe, right, he's just have to continue to pull that money out of that retirement account. It's tax upon tax upon tax, where people don't really realize it until it's too late. Here's the problem is that you have 60 days. A 60-day rollover rule. If you pull the money out, you have 60 days to put it back in, no harm, no foul. But after that 60 days, it's irrevocable, and that's a brand new law when it comes to how you can juggle that 60-day rollover rule this year.
Yeah, that's exactly right.
Or last year, I guess.
Yeah, it started last year, but it came into law last year, but it actually started this year. And Joe, I've got a quick story as well, which is this is a person that we met in our office. He had about $3 million in an IRA. He watched our show, actually listened to our radio show, and he decided, you know what, tax-free income is for me, and he converted the entire $3 million at one time. So get this now, what's the maximum federal rate? Well, it's 39.6. How about state? 13.3, and then there's other phase-outs. His tax rate was over 50%. It was about 55%. So $3 million, roughly about $1.6 million in taxes. That's how you can end up paying a lot more taxes than you need to. And I'm all for Roth conversions. That's getting money out of your IRA and converting it to a Roth, but you want to be sensible as to what tax bracket you're in.
Yeah, you just want to take a look at the taxes. It's the purchasing power. It's not necessarily what you have. So if you look at, if I have $100,000 in the overall account, $500,000, you don't have all that money. You want to take a look at the purchasing power because everything that comes out of that account is subject to income taxes. So it's not necessarily what you earn, it's what you keep. So you want to make sure that you are mindful of that, hey, here's my overall account balances, but then you have to say, well, how much income can I create from that and how much am I going to lose to taxes? That's when you have a successful retirement. Most people forget about the taxes that they owe. Don't go anywhere. We got a lot more to discuss on this overall topic, how to keep more into your pocket, not necessarily the IRS. Don't go anywhere. We got a big birthday special for the big man, Big Al Clopine. Show's called Your Money and It's Your Wealth.
Big Al, it seems like it's been many, many years that we've known you. Happy birthday, buddy. Looking forward to many more great years to come.
Hey Al, happy birthday. You know, it must be frustrating to be a CPA because you can't lie about your birth date because people expect you to be good with numbers. So anyway, have a happy birthday, brother.
Hi Al, happy birthday. It's been great working with you over these last 3 years. To many more, buddy.
Happy birthday, Big Al.
Happy birthday, Al. We love you.
Al, I'd like to wish you a happy, healthy birthday because I don't know what age you're getting up to, but have a great one.
Hey, happy birthday, Al. Here's to many more.
Hey, Al, happy birthday. Looking forward to many more to come.
Big Al, happy birthday. Just wanted to say thank you for all the help you've provided to me in the last 3 years, and I hope you have a great day. Thanks.
Happy birthday, Al. You're younger today than you ever will be for the rest of your life, so enjoy yourself.
Hi, I'm Mike Bernier, Certified Financial Planner with Pure Financial Advisors. And did you know that the typical household needs to save 15% of their annual income to have enough money to retire on, according to the Center for Retirement Research at Boston College?
Hi, everybody. I'm sorry I can't be with you to celebrate my 70th birthday. Happy birthday, champ. As a fighter, you were something spectacular.
Happy birthday to you. Happy birthday, dear.
Big Al.
Happy birthday, happy birthday, happy birthday to
Happy birthday. Happy birthday to you all.
Wow, Justin Bieber even.
That's your favorite singer, isn't it, Al? Justin Bieber?
It is. He is now.
See,
I mean, that was great.
You got Pacquiao in there? You got
Yeah.
Adam Sandler? Man,
Yeah.
You travel, man.
I mean, it feels special.
Yes.
It feels very special. And Joe, you know what? I've just thought you and I have been on the air long enough. We've both had a birthday show, so that's pretty good.
Well,
I mean, considering
we made
your
it this
birthday's
far.
in June.
We made it this far.
Yeah.
Let's go to the true false. Let's see how you did here.
All right, it's an IRA is generally the best type of retirement account because the maximum contributions allowed are $18,000. The answer to that one is false because, first of all, an IRA you can only put $5,500 into, not $18,000. That's a 401k. A 401k 403b, you can put $18,000 in per year. And if you're 50 and older, you can do another $6,000 catch-up. You can do $24,000. Now, IRAs are great ways to go, but we kind of like you starting with a 401k 403b because of employer matches. So the first several dollars you put in, typically your employer will match that. So that's, yeah, 401k 403b is where you want to start, probably.
So when you take a look at distributions, if you have an IRA or a 401k, you still have a required minimum distribution. Now the 401k rules are a little bit different than IRA rules because if I'm still working, I can still contribute to that plan. I do not have a required distribution until I retire. So Al, walk us through a little bit of the RMD rules, required minimum distributions, that mandate by law.
Yeah, and I guess here's the thing. You have to take it starting at age 70 and a half. And if you do not take it, there's a 50% penalty. If you were supposed to take, let's say, a $50,000 required distribution, you have a $25,000 penalty. Plus, by the way, you still have to take the distribution and pay tax on it to boot. So you don't want to miss that. And Joe, as you just mentioned, if you're in a 401k plan and still working, you don't have to take that required distribution until the year after you actually retire. So but here's the thing, it's like as we get older, we tend to get a little bit more forgetful and realize that your RMDs, your required minimum distributions, you do not want to forget those because of that big, big penalty.
Yeah, you're coming up to your required minimum distribution, birthday boy.
Well, that's what President Obama
yeah,
called
70 and a half is coming right around the corner.
No, I haven't even made 60. Come on, don't worry about it. Hold your horses.
When you look here, all right, it's a big deal. It's a 50% penalty. Now, most custodians, of course, are going to tell you. But as you get older, you might not read your mail. So you want to make sure that you take your required distributions out of all of your retirement accounts. Yeah, now, how do you calculate the RMD is kind of another thing, Al.
Yeah, it is. You want to look at your balance in your IRA at year end and then you divide it by your life expectancy factor, which is from an IRS table, and that factor at 70.5 is 27. So you take your balance, divide it by 27, and another way to say that is take your balance and multiply it by about 3.6. That'll be about how much you have to take the first year. Second year, your life expectancy shortens a little bit, and so that factor is lower, so you have to take a higher percentage out. And a lot of people don't realize as you age, you need to take more and more out of your IRA, and therefore you have more and more that's taxable.
Yeah, and then your required distributions are also based on beneficiaries in a sense. So if I'm married to someone that's 10 years younger, then your required distribution goes on a different table. So it gets a little complex once you start taking the distributions out. Because why do they mandate you to take the money out? Is because they want their taxes. You got a tax deduction going in. It was tax deferred all the way through. Now, if you don't take that money out, the IRS is saying, hey, wait a minute, start pulling that money out because I want to get my taxes. And each year as you age, that required distribution increases, increases, increases until you die. And then let's look at some other mistakes that people are making, Alan, is that when it comes to your beneficiary, all right, this is one of the most important forms in your overall financial plan because one of the largest assets that we see that you own is your retirement account. So you want to make sure that you have, first of all, the right person that you want the money to go to. Now, if you have a 403B or an IRA, sometimes you might have an incorrect spouse. 401k mandates or ERISA plans, the spouse has to sign off. So if you're married, don't worry about it. The spouse would have to sign out if she is not the beneficiary. But we've seen some mistakes here. Maybe you're divorced, but you didn't change it to the kids. So you want to make sure that you have the right beneficiary. Or if you don't have any beneficiary at all, it will go to the estate, and that's not very favorable when it comes to taxes. Because an IRA or any other retirement account is a different type of animal. It doesn't pass through your estate plan. It doesn't pass through a will or a trust. Everything will go to whoever you name as your beneficiary. So naming the right beneficiary, that beneficiary form is really, really important. Now, so let's say if your spouse dies, you have a couple of different options. So when it goes to the non-spouse, the kids, the grandkids, it goes to a niece or nephew, a friend. If it goes to the spouse has two options. One, they could keep it in the deceased spouse. So let's say I'm married. My wife dies. I could keep it into her IRA and set it up as an inherited IRA. The reason why people would want to do that is let's say if you're under 59.5 and you need access to the money. You can have access to the money at any age under 59.5. You, of course, will pay the taxes, but let's say I'm 45 years old, my wife dies, I need access to the money. I would keep it in her name, then I can have distributions. Now, if I'm over 59.5 and it's for retirement, maybe I might want to roll that money into my own so I can add it to my own account. Now, non-spouse beneficiaries. This is something completely different. This is a different animal because spouses is easy, all right? I'm going to keep it into hers or I'm going to take hers and roll it into mine or vice versa. But now when it goes to the kids or the grandkids or someone that is not a spouse, there's some different things that you have to take a look at. Here's the 5-year distribution. I think, my opinion, we're going to go back to this. The rules changed in 2000, and what that means is this. Let's say you have $1 million in your retirement account, you die, it goes to the kids. The kids now have 5 years to take that distribution out. Everything has to come out within 5 years. So if you name your estate, the 5-year distribution will probably apply. So you want to make sure that you have the correct beneficiary. However, here's where the rule states today, is that you can elect to stretch, or the kids can stretch out that tax liability. Think about $1 million inherited. They would have to take all that money out within 5 years. That's going to be a huge tax. However, they could stretch that tax out over their life expectancy, okay, if they set it up appropriately. Now, a stretch IRA works like this. Let's say I pass away. It goes to Junior. Titling has to do this. Joseph Anderson, deceased on whatever date that I died, for the benefit of Junior. Now, Junior doesn't have to pull all that money out. He doesn't have to pull it out within 5 years. He has until his life expectancy to pull that money out. So the distribution is going to be very, very small, depending, of course, how old Junior is. For this example, let's say he's 5 years old. His life expectancy is age 85. He has 80 years to pull the money out, so you can continue to defer all of that money for many, many, many years. This is a great way to parlay wealth. However, stay tuned. The tax legislation may change, and they might get rid of the stretch IRA. So stick around to this show because we're on top of it, and we're going to give you up-to-date news when it comes to your overall taxes, retirement plan, investments, and the like. Don't go anywhere. We got a lot more to discuss. Show's called Your Money, Your Wealth.
Hey, Big Al. I know we haven't met, but I'm Dr. Groff. I'm a cosmetic dermatologist here in San Diego at Cosmetic Laser Dermatology, and your colleagues have been a little bit concerned about you. They've told me that you've been out in the sun a lot and you're potentially looking a little bit older than you really are. So they brought me in to kind of talk to you and figure out what we could do to help your skin look a little bit better. And really, you know, you should think about investing in the future of your skin so you'll have better returns working with the networks and so forth. Because if you don't, they might bring in a younger guy thinking they're going to get a better return on their investment. So here's some things I have in mind for you, Big Al. First, when we look at your skin, it looks like you've been out in the sun quite a bit. I don't know if you've been surfing, maybe using tanning beds, I don't know. But there's a lot of brown spots here. And if you look around the eyes, you can see there's a lot of wrinkling here. Certainly there's some heaviness to the eyelids, which we can definitely address with laser resurfacing. There's a little bit of laxity going on right here. We have a perfect procedure that has no downtime. It's called ThermiTight. And we can tighten that right up for you. The other thing we can think about doing, Big Al, is maybe just peeling your skin with a laser just to give you a fresh new start. We can take you from 50 to 30 in about a week. So rest assured, Big Al, at our practice we have over 45 different lasers. We got every injectable from Botox to Voluma to Juvederm. We're going to get your face back into shape. But more importantly, I just want to say happy birthday from all of us, from San Diego and from the entire crew. Have a great birthday, buddy.
Wow.
Alan,
Well, I'd say that's relatively accurate. Although, Joe, I used to do radio. I still do radio. I didn't have to worry about this. Now I'm on TV. I guess they're telling me I need younger skin, right?
Well, you know, Dr. Groff is actually 70 years old. He's 70. But look at that skin,
Yes.
man.
Yes. Well, he looks great.
Gorgeous, right
Yeah.
there.
Yeah, and apparently I've got I need a lot of work done, don't I?
Let's go to the true-false question.
All right, let's see. If I take my first required minimum distribution by April 1st of the year after I turn 70 and a half, I can avoid penalty, but I must take a second required minimum distribution in the same year. And the answer to that is absolutely true. And you may not know this. When you are 70 and a half, you have to take that required distribution, but the IRS says you can actually push it off till April 1st of the following year. But if you do that, now you have to take 2 required distributions in that year. Now, if you're working most of the year while you're 70, maybe you turn 70 and a half, have high income, you're going to be lower income bracket next year, that might be a good thing to consider. But yeah, that is available.
Yeah, you do have to take 2 out, so you want to make sure that you do some tax planning there. Who makes up these laws, right? So once you reach 70 and a half, do you have to take the required distribution? No, wait a minute. It's April 1st the following year, you turn 70 and a half, but if you wait for that date, you have to take 2 of them. So anyway, let's go to email questions. There's a lot out there, so let's start answering those.
Well, I think so, and of course I'm standing in front of Waikiki Beach, but anyway, we'll take a break from that. This is Mary in San Marcos. She says, I'm retiring this year with pension income, investments, a 401k, and Social Security to draw from. Which sources should I turn to cover my expenses first? So that's a loaded question. There's a lot going on here. And it depends upon what age you are, and have you already started taking your pension? Have you already started taking your Social Security? If it's pension, should you wait a couple years? Will you get more? Should you take a lump sum? Social Security, should you wait and collect more later? I guess a big overriding thing here, Mary, is what's your tax bracket? And depending upon your tax bracket is going to help you to decide how much to pull from each of these different investments.
Right. I mean, I think that's the thing that's missing now, is that you kind of put this in a cookie cutter box, and it's like, okay, well, maybe I draw from my investments, I defer my retirement accounts, maybe I take my Social Security, so I'm not dipping into my retirement accounts. But no, you have to take a look at your taxes to say, all right, well, here, how much should I be pulling from my retirement account to keep me maybe in the 10 or 15% tax bracket? Then I can push off Social Security because that's given me an 8% increase. And then I take it from investments, or do I have pension income? So it's a little bit more complicated than just saying, hey, take this first, then that, then whatever. Do a little bit more planning, Mary, and I think you'll be better off. Let's go to the next one.
We've got a question from Bill in La Mesa, and he asks, what's a good investment strategy to help me create income in retirement? Are municipal bonds a reliable source of retirement income? What do you say, Joe?
Well, it depends. You take a look, all right, well, what type of bonds do you want to buy? General obligation, revenue bonds, how far do you go out on the yield curve? Yeah, I think municipal bonds is a really good way to generate income, but you have to take a look at your tax bracket first and where are the assets. A lot of times, some of you buy municipal bonds inside your retirement account believing that you'll get a tax-free distribution. That isn't the case. So if you have a lot of assets outside of retirement accounts, if you have larger pensions, if you're taking larger distributions from your overall retirement accounts, yeah, municipal bonds might be a great way to go. Be careful though, because interest rates are very, very low. So as interest rates go up, bond prices fall. Now, if you hold that bond to maturity, of course you're going to get that income. Then you have to take a look at the credit quality and everything else of the bond, so it gets a little bit more complex. But for a long answer, yeah, go for it, man. But you want to make sure that you're in the right tax bracket. First and foremost, want to thank the big man for being alive again for another year.
One more year, eh?
One more year to go, brother.
And I know I need a lot of work, but we'll work on it.
And I want to take the opportunity, take a look at this cake. Cuba Creations. Beautiful cake. It took like 2 days to make. So definitely want to thank Cuba Creations. I can't wait to dig into that once we get out of here. And then, of course, Dr. Groff, the 70-year-old surgeon that looks like he's 38. So I appreciate that. Tune in next week. What we're going to get into is more financial planning issues that you want to make sure that you are on top of. For Big Al Clopine, I'm Joe Anderson. Have a wonderful, wonderful weekend. Show you just watched is called Your Money, and it's Your Wealth.